Hey, what's happening, options traders? Well, I've talked about in many videos about the buy right, which is also the covered call. And recently I mentioned about the buy right index, but I didn't really go into detail. And so I had some people email and say, well, what exactly is the buy right index? And could you give us some more details? So sure, why not? Well, the buy right index, or the BXM, is one of many indexes you can find on the CBOE's website, CBOE.com, and it's worth taking a look. So there's a lot that you might find will help you to make decisions. And certainly for options traders, the buy right index is one that you'll want to know about. So what exactly is it and how does it work? So first, recall the strategy of the buy right. You're going to, let's say, buy 100 shares and then sell a call against those shares, always in a 1-to-1 ratio. So if you buy 200 shares, you could write 2 calls and so on. Now, you might know this by its more common name, which is the covered call. Same thing, you are buying shares and selling or writing calls against it. Now, there is a super fine technicality here if you want to split hairs. Usually when people talk about a buy right, it's done on the same ticket. So you're going to buy the shares and simultaneously sell the calls. But again, it's a technicality. You still end up with the same strategy. But the main thing to understand is from the strategy is that you are collecting premium. So yes, when you sell this call, you are getting cash into your account up front. And that's what leads traders to say, well, it must therefore outperform the long shares alone, because I'm still going to get the capital gains on the shares, I'm still going to get any dividends, but I'm also getting this premium from the calls. Well, it's a good thought, but let's take a look. Will you have superior returns? So first, take a look at an example. Let's say that we buy shares at 100 and we write the 105 call for 2. This would be our resulting risk graph. And notice that the maximum gain is 7. And that's because if we paid $100 for the shares and we have the obligation to sell them at 105, then that's $5 of a capital gain. But we also received $2. And so that's where this maximum 7 is coming from. And we can see that it occurs for all prices above our 105 strike here. So if we overlay this with 100 shares, this is what it looks like. So notice that the long stock position, obviously just a straight line, but it breaks even right here at 100, the price that you paid. Notice that the covered call, or the buy right, sits a little bit to the left. You see how this blue line right here crosses 0 a little bit sooner on the graph than the red line. It's pushed this way by $2. That's the amount of the premium that you received from the sale of that call. So that means if you are on the blue line, that your break even is actually 98, not 100. So the first thing to notice is that you have a little bit of a risk reduction. Not great, but certainly a little bit by, in this case, 2 points or 2%. But we also have to look at this. Do you see how we have the obligation to sell our shares for 105 no matter how high that stock price goes? And that's why this blue line flattens. So if we just held the shares of stock and we didn't do the covered call, we might make more money. So this is really just a risk-reward relationship. We have less risk with the covered call, and we therefore have less rewards. So that should be the key insight, is that even though you are collecting premium, yes, that will, or at least have the ability to potentially bolster those returns, but the downside is that you're giving up the unlimited upsides. So the limitations of the covered call or the buy right are these. Call writers give up the occasional home run, and you cannot discount that. No matter how unlikely it seems for that stock to, let's say, go above 105, it can and does happen. You wake up, stock opens up on the opening bell and it's trading at 120 and continues to run. And you're not participating in it. All you got was the $2 plus the 5 points of potential capital gains. See, that's what the covered call writers tend to overlook, is that they will miss out on occasional home runs. So again, you are reducing the downside break even, so you are reducing the risk, and therefore you must be reducing the reward, at least in the long run. Well, it still brought up an interesting question. Maybe the risk premiums in the options are so great that they more than compensate us for these missing of the occasional home runs. So in 2002, the CBOE created the Buy Right Index, or the BXM. So what they did is that even though it was formally announced in 2002, the data is from 1986 to the present. And I believe the original study was actually 1988 and then to the present, but in order to get the data started, they had to actually go back to 1986. So even though it wasn't officially released until 2002, you're going to see the data going much further back. And the way that it works is this: it's a hypothetical 30-day at-the-money option on the SPX, or you can think of it as the SPY. And so they take a look at the volatility and they say, here's what a theoretical 30-day at-the-money option would be selling for. And what they're going to do is, instead of looking at exactly at the money, they're going to go to the next strike out. Wherever this index is, whatever the next strike in line is in the real world, they're going to sell that one. So once again, wherever the current index is, whatever the next strike in line is, whether it's 50 cents out of the money or $4 or $5 out of the money, whatever that strike is, that's the one that they sell. Now this was done long before they had the weeklies, so they've still maintained this 30-day expiration. So on expiration Friday, the option either expires worthless, or if it's in the money, they theoretically buy it back and write a new one. So the idea is that they never lose the shares. They just want to continue writing options, collecting any dividends, and seeing if they can outperform the indexes. So part of the problem here too is, remember, you might get assigned early if there's a dividend. So that's another wrinkle that this index doesn't really cover. But it's still an interesting idea of saying, hypothetically, if we compared somebody who just held the S&P 500, long-term buy and holder, compared to somebody else who bought the same index but also wrote these out-of-the-money calls, who would outperform who in the long run? And that's exactly what the BXM does. So let's jump over to the CBOE's website and take a look. So here we're at the CBOE's website, and probably the easiest way to get to this page is just go to Google and type CBOE BXM Index and it'll come right up. But here is a nice little graph, and you can see the performance. So this gives us a long-term performance. So we've got a nice little slider bar down here. You can kind of zoom in. Another nice thing that they do is they show you key points, big moments in history here that were really kind of market changing, and if you hover over it, it'll tell you what those events were. Gives you some indication of why the markets might have been up or down. So up here at the top is the current level of the index, and you can put this into your broker's platform. If you have E-Trade or Thinkorswim, just type BXM in the quote box, just as if you were typing in IBM or another ticker symbol, and this is the number you're going to see. So another thing here is, let's take a look at the comparison box, and let's type in SPY and compare. All right, so now if you hover over them, you can see that the BXM is in blue and the SPX or the SPY is in green below it. So you can see that there are certainly moments in time where the buy right strategy outperforms. Now, part of the reason this was happening back here, notice that we're in 2008, 2009, we're just coming out of this 2007, 2008 financial crisis. And during those times, yeah, the premiums were really, really high. Prices weren't certainly going up, and if anything going down, but at least it offset these losses. So in relative terms, the BXM certainly outperformed. So it's not saying that it can't have moments where it outperforms, it's just in the long run, we wouldn't expect it to outperform a portfolio of just holding the SPY. So let's take a look in a little bit closer out here. And if we bring it up to, so now you can see that the green line for the index itself sits above the buy right index. And this is really what you would expect in the long run. So look for this time period right here. The index is up 100%, whereas the BXM is up about 50%. Actually, if you hover over it right there, it's 98.5 versus 40 and change, but still better than double. So there are obviously a lot more rewards for holding on to the index by itself. So it's a nice little tool that can give you some good insights when it might have been more appropriate to write covered calls versus not. But I think the main thing to get from this video is that just because you might hear about the covered call, some of you might be brand new, and have this idea that it must outperform the index because you're holding the index plus you're getting these premiums plus you're writing out of the money calls, it's simply not true in the long run. But that doesn't mean that the covered call is a bad strategy. You could also split the difference and at least capture the average volatility over both strategies. Just some things to think about. But for anybody who wondered what the BXM is, the buy right index, hopefully that gives you some more details. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. You can also instant message me right here in Facebook.